The gold-silver ratio is let's say 1 to 10 or 10 to 1. And when gold is trading 5,000, which is still cheap in my book, silver should be trading around $500. But as said, when Deutsche Bank says that gold could be trading well north of $10,000, if you use the 1 in 10 ratio or 10 in 1 ratio, silver could be trading $1,000 pounds. So I think it's very early in this generational bull market, and people will be surprised by the returns to be made in the next few years.
The global commodities supercycle is reaching a critical inflection point as tangible assets systematically outperform traditional debt instruments. Investors navigating today's sticky inflation and market instability must closely examine the structural supply shortages in physical metals. Willem Middelkoop, a seasoned macro investor and financial author, projects that we are witnessing the opening chapter of a generational bull run across raw materials. His core analysis forecasts silver recovering to $100 short-term before executing a massive surge toward $500 or $1,000, alongside gold climbing well north of $10,000 to $14,000 as historical 10-to-1 gold to silver pricing ratios realign. From an independent analytical perspective, this bold target is backed by real-world industrial silver deficits and relentless fiat currency expansion. As mining equities rebound off multi-year lows, securing exposure to precious metals provides a crucial defensive shield against unpredictable broader market volatility. Now, we present the clips from Willem Middelkoop's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
I think the start of a new bull market in gold and silver, and more broader in commodities in general. And I think you will do well long term when you position yourself in gold and silver stocks, but also copper and uranium. Like I said, the fundamental supply and demand situation is very positive for all these metals, also for uranium. But if we focus on the precious metal stock, which had this huge correction in the last 6 months, I think we can call the bottom. In the last few days, we've seen a big recovery. Our fund is trading positive year to date. We're trading up 4%, 5% up in July. And if you look at the technical pattern, I just looked at a very long graph. You might know the gold and silver index, the XAU, and that one started around 1980. And if you look at the larger pattern, the XAU broke out over a 40-year, let's say, sideways pattern in October 25. And has now fallen back to test that major breakout area. And when you turn on a technical support level like this, you could get another very strong move upwards. And we think that the strong rise that we have seen in the last 2 years was only the first part of this major new bull market in precious metals, and we could well witness the start of the next leg up now, and the next leg up could well be stronger and longer than the move up that we've seen in the last 2 years. Gold is coming back within the financial system. They showed a graph that the total gold holdings by central banks is now larger than that treasury holdings. They also pointed to the fact that gold is moving back into the strategic reserves from central banks, and is now around 30% of those reserves. And they point to the fact that historically it used to be over 40%. So they predict and conclude in their report that this bull market for gold is just starting. And when they tried to predict where the gold price was heading, they said that based on these historical patterns and the huge demand by central banks out there, you could well get a gold price of to 14,000 per ounce. And this is not just some crazy gold bug writing a report. It's the Deutsche Bank. So that's telling. Silver is always more volatile. So silver price came down by over 50%, which is a great technical correction. And gold and silver retracing, especially silver retracing back to the breakout levels around $55. That was a wonderful buying opportunity. And actually, I bought some more myself. And I wouldn't be surprised when silver goes back up to $100 in the next few months. And I could envision silver going back to hundreds of dollars per ounce in the next few years. And I'm on the record. I gave a presentation in January and March this year at the VRIC in Vancouver, where you're now, and in March at the PDAC in Toronto, that this bull market in silver will not be over before we see $500 silver. So that's another 10x. And you can imagine what silver stocks will do in a rally like that. And why could silver reach $500? Because there's this historical pattern that the gold-silver ratio is let's say 1 to 10 or 10 to 1. And when gold is trading 5,000, which is still cheap in my book, silver should be trading around $500. But as said, when Deutsche Bank says that gold could be trading well north of $10,000, if you use the 1 in 10 ratio or 10 in 1 ratio, silver could be trading $1,000 per ounce. So I think it's very early in this generational bull market, and people will be surprised by the returns to be made in the next few years. People always make the mistake by judging short-term price moves and then change their opinion about a metal like gold. But if you look at the larger picture, if Deutsche Bank is right, if I'm right with my big reset thesis, we see a U.S. empire in decline, which means that demand for U.S. treasuries will go down and will continue to go down. And we can we can see that this trend is unfolding, as I've explained, that central banks are selling U.S. treasuries and are adding to their gold reserves. So the bigger picture is still still there.
Yeah.
And when you're when you see the start of a big trend, you can expect the trend to continue. And I just looked at the numbers of central banks. Central banks, they own around 11 trillion in bonds. They own around 4 or 5 trillion in treasuries. They own around 5 trillion in physical gold. They added some 600 billion in physical gold holdings over the last 4 or 5 years. So if they continue to sell some of their treasuries, let's say 20% of their treasuries, that's another 1 trillion, which could be turned towards gold. And that's almost double the amount of money they used to buy more physical gold in the last 5 years. And that's exactly what Deutsche Bank concluded in their report. It's about central bank demand. It's not about retail demand.
Technical charts demonstrate a powerful multi-decade breakout, confirming that recent price drops were simply a healthy consolidation before the next leg up. Central banks now hold more physical gold than U.S. treasuries, allocating nearly 30% of reserves toward bullion. Institutional models indicate that shifting just 20% of remaining foreign debt reserves could channel an astonishing $1 trillion directly into physical gold markets. While a brief short-term retest under $4,000 per ounce remains possible, precious metal equities are already reversing upward. From an independent commentary standpoint, this aggressive sovereign accumulation proves that global monetary authorities are quietly de-risking their balance sheets. Central bankers recognize that holding paper debt carries growing counterparty risk, making an allocation shift into unencumbered hard assets completely logical and necessary. Now, let's get back to the interview.
Demand is totally different from retail demand. Central banks don't buy gold because they speculate it will go up. Central banks buy gold because they understand that we are in this declining US dollar empire. And I've always been quite critical of central bankers, but I've learned to know them a bit better over the last 10, 15 years. And I came to the conclusion that central bankers, sometimes they do stupid things, but they aren't stupid. Central banks have studied monetary history quite well. They understand the rise and fall of monetary systems. And when they see a decline of the current dollar system, they understand they need to hedge themselves by buying gold. And that message, it's something they don't advise you and me to do, but like I like to say with central bankers, don't listen to what they say, but just look at what they do. And if they're all buying physical gold, well, they're doing that for a reason, and that's to hedge themselves on the major risk of the current dollar system. I think we've seen the bottom in this correction. We might get a retest of that bottom. I wouldn't be surprised to see gold going under 4,000 one more time. But if you look at the gold stocks, I think they are turning up again, and they will continue to recover, and we see this as the start of the next leg up. Gold would become more important into the financial system, and the dollar would be starting to get in decline. And I think that's just what happened over the last 5 to 10 years. And central banks, as said, are hedging their, let's say, dollar risk by increasing their gold holdings, because they know from history, if you get a monetary reset, if you see these huge changes coming into the monetary system like we have seen in the past every 80 to 90 years, you know gold is the stable asset without any third-party risk, which you'll need in times of financial crisis. And nobody knows what shocks will start to appear. And as said, I expect another major crisis to develop somewhere in the next few years out there, and that could well be a sovereign debt crisis. And if you get a sovereign debt crisis, then gold will show its true face as the safe haven asset. The US has started to weaponize the US dollar, especially in the last, let's say, decade or 15 years. And there's even a wonderful book written by a former U.S. Treasury official. It's called Treasury's War, and that book explains perfectly clear how the U.S. has started all these financial economic wars by weaponizing the U.S. dollar, and especially after the start of the Ukraine war, well, many countries learned that it's a risk, it's a liability to hold U.S. treasuries, and we've seen Russia getting rid of all the treasuries, we've seen China selling the treasuries down, so the U.S. needs to roll over quite a lot of the U.S. treasuries every year. I think it's 8 trillion over the last 12 months. So the U.S. National debt is reaching 40 trillion now. So it's a dangerous game we're playing, and one thing is clear for me: we're on this unsustainable path, and when interest rates are starting to move up sharply, like we've seen in the last few quarters and the last few years, then there's a big risk out there for a new financial crisis, and which isn't discussed in the media. So we keep ignoring this huge problem. And if we look at the past, of course, we know that on average, every 90 years, we see a new major world reserve currency entering the system. The US dollar was the successor for the British pound. This US empire, which really started after the Second World War, that's now 81, 82 years ago, that followed the British Empire. And the British Empire was around for quite some time, but we've had the Dutch Golden Age, and we've seen an era where the French were in control over the financial system in the Western financial system. So it's quite normal after 85 years after the start of the Second World War to see a new competitor rising, and that's China. China is leading the BRICS alliance, and China is working very hard to have bilateral trade with many countries in other currencies than the US dollar. So the US dollar system is in decline. This doesn't mean that the dollar will collapse and go to zero. The pound sterling is still there, although the British Empire is not around any longer. But it's very hard to envision when the crisis will arrive and how it will unfold. But many of these major crises come in three waves. And you could say we had a first US crisis, a first wave after 2000, after the collapse of the tech bubble in the early 2000s. Then we had a second wave, a huge financial crisis, the great financial crisis in 2008 after Lehman collapsed. And I wouldn't be surprised to see a third wave which could be an even larger crisis. And this could well be connected to the sovereign debt crisis or the collapse of the US dollar system. But it's very hard to predict how this will all play out.
The global monetary framework is accelerating toward an inevitable reset as the US dollar's dominance wanes. Global reserve currencies historically operate on 80 to 90-year supercycles, and the post-World War II dollar regime is hitting severe economic limits. The expanding BRICS bloc is rapidly shifting international trade away from Western debt instruments. With U.S. national debt topping $40 trillion and requiring over $8 trillion in annual debt rollovers, weaponized financial policies have incentivized central banks to systematically liquidate treasuries. Predictions point to an impending third major economic wave following the 2000 tech crash and 2008 financial crisis, manifesting as a severe sovereign debt collapse in the coming years. Evaluating these macroeconomic headwinds, it becomes clear that fiat currencies cannot sustain current national debt burdens without hyperinflationary money printing. Physical gold remains the ultimate risk-free sovereign hedge, delivering crucial stability during major monetary realignments. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.